Welcome to Accounting 201, Financial Accounting at Kapiolani Community College. In this video, we'll take a look at the instructor notes for Chapter 3 of our text. First, we want to do a recap of the debit and credit rules to remind you what kind of accounts we'll be working with and what their normal balances are. You can find this information in Chapter 2 PowerPoints. Recall, once you've prepared a journal entry, then the journal entry must be posted to the accounts that are impacted by it. So when we're doing the adjustment process, we'll be making adjusting type of journal entries and posting them to the account balances that are typically impacted by those entries. An important reason why we have to make adjusting entries is because of the time period principle. Accountants break the life of business into chunks of equal length so that they can compare 1 year or 1 month or 1 quarter to another. Recall also from Chapter 1 that revenues are recognized during the period where they're earned. Even if we did not receive cash during that same period, we're still going to record revenue if the service was provided to our customer, especially in cases where the transaction has not been completed or perhaps the paperwork has not been completed. We may have a situation where we have recorded revenue and the cash is not received in that period, and our automatic recording procedures are not going to pick it up. So we'll have to override our system and make an adjusting entry to make sure that the revenue is put into the proper period. Same applies to expenses. Expenses should be recognized during the period which they were incurred. Incurred means made them happen. If cash was not paid during those periods, then we also might have to make an adjusting entry. And in some cases, it's difficult to tell exactly when the expense was incurred. So in those cases, accountants typically try to match the expense with the periods where they earned revenues that were related to that expense. So adjusting journal entries are a real key to the accrual basis of accounting. Often in accounting we have to make guesses, we'll call them estimates, and accountants tend to prefer conservative estimates to liberal estimates. So what we're trying to do, we're trying to get revenues and expenses in the correct period, trying to get all assets and liabilities correctly stated. Now, there are two kinds of accounts that we can make adjusting entries directed towards, and there are 3 and 2 types of adjusting entries for them respectively. So it's a total of about 5 different types of adjusting entries. That's really all you need to know is these 5 formats. So first of all, whenever we have revenue, revenues are going to either increase assets or decrease liabilities. We have 2 kinds of adjusting entries dealing with revenue. The first one is called accrued revenue adjustment. Accrued revenue is a situation where we have earned the revenue but we haven't yet received the cash. So in that case, we'll debit an account called something or another receivable, like for example accounts receivable, interest receivable, and credit a revenue account. Remember, revenue accounts have keywords in them, either revenue or income or earned can be thought of as synonyms. So say for example we had earned interest and not yet received it. We would debit interest receivable and credit interest income or interest revenue or interest earned. An opposite type situation with regard to revenues that need adjusting entries is where we have received money from the customer before performing the service for the customer, and now during the accounting period we're trying to get as accurate as we can. We need to reflect the fact that we've done some of the service that we collected that prepayment from the customer for. In that case, we'll debit the unearned revenue account to reduce it and credit our revenue account to increase it. So notice in both of these cases, revenue is going up because essentially revenue only really goes up, hardly ever or basically never goes down. One adjustment results in an increase in an asset, while the other adjustment results in a decrease in a liability. Those are the normal impacts of having revenue. We can also have adjusting journal entries related to expenses, and there are 3 of them, 2 major types and 1 that's just a variant on one of them. When we have expense adjusting journal entries, those are going to either make our liabilities get larger or our assets get smaller. And just like revenues, we have accrued expense adjustments. Accrued expenses happen when we have an expense that's incurred before cash has been paid. So in that case, we have to adjust the expense account upward and increase our liabilities, specifically a payable type account for that. So let's say employees had earned some salary, but it wasn't yet the end of the pay period and it wasn't time to pay them, but it was the end of our accounting period. We'd want to put the salaries that they earned, or our cost that's been incurred for salaries, in the period where the employees earned it. So the adjusting entry, salaries expense, salaries payable. Similarly to revenues, we also have situations where cash has changed hands prior to the income statement item happening. In this case, if we have paid for expenses such as insurance or maintenance fee or even supplies before we've used those services or goods, then when the time comes to reflect that we have used them, we've got to make this adjusting entry. So we might say, for example, supplies expense and supplies, the asset account. Or we might say insurance expense and prepaid insurance. There's one last kind of adjusting entry, and that has to do with depreciation. Depreciation is an artificial process of making our long-lived assets reflect the fact that they've been around for a while and are kind of getting worn out, or alternatively you could think of them as there is some cost to having to have them in order to help them help us generate revenue. In this case, we'll debit depreciation expense. That's much like this one over here. And we'll credit an unusual account called accumulated depreciation. Accumulated depreciation is a contra asset account, and it reflects all the depreciation we've recorded on an asset since it was acquired. Now we'll only do this with long-lived assets, so buildings, equipment, furniture, fixtures, vehicles, and that kind of thing, not supplies. And we won't say, for example, depreciation expense insurance. That just doesn't match. It only works with long-lived assets. When we show assets, long-lived assets, commonly called plant and equipment or property, plant and equipment, or fixed assets on our balance sheet, we'll show them at their total cost, and we'll subtract whatever the latest balance is in our accumulated depreciation account to come up with what's known as its book value. That's the amount that gets added into the total assets. So if you want to take a big picture view of adjusting journal entries, we make adjusting journal entries to make our financial statements more accurate, and they're going to happen anytime we have revenue or expense that's not in the same period as the cash, or a situation where the revenue is being earned or the expense is being incurred over more than one accounting period. So trying to get all the revenues and expenses in the correct period, and we want to get all of our assets and liabilities correctly stated. So 4 things they have in common. Number 1, they're dealing either with revenue or expense, and the revenue or the expense, whichever it is getting bigger. Mechanically speaking, whenever we have expenses getting bigger, we have to debit an expense account, or whenever we have revenue getting bigger, we have to credit a revenue account. In addition, an asset or a liability will be impacted by this adjusting journal entry. So if it's a revenue, either assets will be getting bigger or liabilities will be getting smaller through a debit. And if it's an expense, either liabilities will be getting bigger or assets will be getting smaller through a credit. We'll never ever have cash involved in the adjusting journal entry. If we did, we would have recorded it automatically anyway. So that's not going to happen. Cash must have occurred before or after our adjustment period. So recap here. Accrued revenues, cash will be received later. Accrued expenses, cash will be paid later. Deferred type of adjustments. Prepaid expenses, cash was already paid. Unearned revenue, cash was already received. So the accountant looks at the accounts on their trial balance and asks, probing questions like, are there any unrecorded situations that have more revenue or expense that we need to reflect? Are all of our assets and liabilities correctly stated? So when we put all of this together, this is how our entire accounting cycle fits. This is not in the book in this order, but it's, I guess, implied. First of all, transactions have to happen. We prepare source documents to reflect those transactions happen. We make journal entries to reflect the nature of the transactions and the impact of them on the accounts. Post those to ledgers. Get an unadjusted trial balance, which can be thought of as a rough draft. Make adjusting journal entries. Post those entries to the ledger. Get an adjusted trial balance, and then finally make more accurate financial statements. So let's take a look at a recap of these things. If we have accrued revenues exist when we have revenue earned but not yet received. The adjusting entry will have this kind of impact on the accounts affected. Unearned revenues occur when we've received money before doing the service. When we do the adjusting entry for unearned revenues, they'll have this kind of impact on the associated accounts. Expenses. We can have accrued expenses, which exist when expense has been incurred but not yet paid. You'll see it reflected this way on the accounts. And we can have prepaid expenses when they've been paid for ahead of time and finally now using up the asset. So all of those are a recap, and you can find these in the PowerPoints for this chapter. So to try and compact all this information in the shortest possible space, I've prepared this worksheet for you, or handout, I guess. And this classifies our adjusting entries by the type that they are: accrued expense, prepaid expense, special case of depreciation expense, or accrued revenue or unearned revenue. In the case of prepaids, prepaid expenses occur, or prepaid expenses are expenses that have been paid for before being used. If we're in this current period right here with our street signs, we are in the period where we're having to make adjusting entries. In a prepaid situation, we've already paid for the item ahead of time. Now we have to reflect it as being used up and turning into an expense. If it's an unearned revenue, we've received the money ahead of time, and now in the period where we're making our adjusting entries, we have to reflect that not as much of it is unearned anymore because we finally earned some of it. In the case, however, of accrued expenses, we are incurring an expense now and not paying it till later. And later on, the payment will occur. Or accrued revenue, we're earning the revenue now and not going to be receiving it until later. So I hope this helps. And just for some perspective, we want to see, like, essentially doing adjusting journal entries is overriding our normally recorded transactions, going in and making the account balances be what we need them to be. So we make these special entries in order to make that happen. It's kind of like this. Your accounting system, adjusting journal entries, new account balances, victory!